Hello, and welcome to this LCM webinar on integrating legal considerations into transfer pricing and tax compliance. So really the focus of this session is from a practical perspective, especially for tax and transfer pricing professionals, whether you're in-house or in private practice. It's about how to engage effectively with lawyers so as to ensure substance in intercompany transactions and ultimately protect the corporates involved. My name is Paul Sutton. I'm one of the co-founders of LCN Legal, and we are lawyers who specialize in this area. And I'm going to talk you through the basics of this subject. So the agenda is going to be, firstly, we'll just have a very, very brief recap on the fundamentals of intercompany transaction management. Next, we're going to look at how to assess the potential need for action on intercompany agreements or ICAs for any given group. Next, we're going to talk about how to effectively engage with the legal function, including the in-house legal function, and maximize the resources and the support which they can provide. Then we're going to look from a practical perspective. So for any given group, any given point of time, where do you actually start in this kind of project? Hopefully we'll have some time for Q&A, and then we'll close with some key takeaways and point you towards some free resources and support. In terms of housekeeping, if you do have any questions, please feel free to use the questions function or chat function for this webinar platform, and we will be circulating slides after the event and hopefully the recording too. So let's dive in and talk about the fundamentals of intercompany transaction management. And this slide, hopefully it illustrates what you already know if you're on this call, which is the management of intercompany transactions is not just about transfer pricing documentation and preparing that after the event. So it's not just about preparing master files and local files and so on. The requirement in each respective financial year of the group is to plan the transactions in advance, implement them in advance, and that includes operationally and through appropriate agreements, to operate the relevant transactions and the price setting policies in real time during the year, and actually monitor transactions, including monitoring margins. And then after the year end is the filing. So that includes not just TP filings, but actually it includes corporation tax returns and statutory accounts for the relevant entities. And the reason why TP and intercompany transaction management cannot just be left until after the year end is that at that point you can't rewrite history. You can't rewrite history as to the terms of the intercompany agreements which are in place. You can't rewrite history as regards the legal fact pattern or any other feature. And therefore the only robust approach is to look at it from this perspective of plan, implement, operate, file, and then later down the line that is defend. And of course the reason why we're doing that is that it's actually the defend point in time. So when the tax audit happens, that's when you or the relevant group knows that it has received the proper support, because hopefully it is able to produce documentation showing that form of transactions is aligned with substance, is aligned with actual operations, and aligned with the data. The next slide, which I think some of you will already be familiar with, is just to really emphasize the fact that it takes a cross-functional perspective to design and implement appropriate intercompany transactions. So it's not just about tax and transfer pricing perspective. It's not just about legal. It's also thinking about IP protection from the point of view of, can the group actually effectively protect its IP, and making sure that the legal structure, the legal ownership of rights in IP is actually aligned with the group's enforcement policies, as well as being in alignment with the TP perspectives in terms of DEMPI and so on. And obviously, as many people will know, withholding tax considerations, tariffs considerations can be, from a practical perspective, just as material as transfer pricing considerations, because they can apply in real time. If you've got a tariffs issue or customs issue, that can mean that goods get held at the border. If you've got withholding tax issues, then those deductions may need to be made in real time by definition. And so you've got an immediate compliance issue if you haven't correctly delineated intercompany payments in agreements and appropriate documentation so as to support the withholding tax considerations. So I'm not going to go into this cross-functional perspective or intercompany transactions health wheel in more detail, because this is the kind of thing that we cover in deeper dive webinars and materials, but really just to emphasize the points that the design of intercompany transactions presupposes that all of the stakeholders have been identified in advance, and those stakeholders have influenced the form and substance of the transaction design, including the intercompany agreements, so that forms the foundation on which the company, or the group rather, can actually monitor transactions in real time and then report accurately after the event. In terms of the legal, or the role of contractual and legal considerations in transfer pricing analysis, again, I'm not going to go into this in any detail at all on this webinar, because we provide other sessions with deeper dives. But the key takeaway is, I'm sure, as you know, if you're a transfer pricing professional, contractual allocation of risk, the contractual structure of remuneration, the contractual allocation of rights in IP, this is absolutely fundamental to the economic analysis of transactions, as illustrated by the various quotes on the left-hand side. And it is at the heart of the 6 OECD steps for delineating a transaction with respect to risk. So what that means, again, just by way of brief recap, in terms of the role of legal in transfer pricing, I think in the past, the temptation or the reality has been that maybe 10, 15, 20 years ago, legal considerations were regarded as an afterthought and were maybe neglected, as shown by a whole raft of cases. But the reality is that legal considerations are an input into transfer pricing analysis, because they can change the economic environment and the economic nature of controlled transactions. And that includes things like the legal operating model of the group, the entities involved, the legal rights and intangibles, the regulatory environment, and obviously the existing ICAs, intercompany agreements. So all those elements of the fact pattern need to be properly identified before the transfer pricing and economic analysis can take place. But equally, legal is an output from transfer pricing analysis, because once a transaction has benefited from the proper transfer pricing analysis, including DEMPI and risk analysis, then one of the outputs from that initial TP analysis is to actually implement those transactions in legal reality through new or updated intercompany agreements or through a group reorganization. And those transactions need to be subject to the appropriate corporate approvals and legal filings as for any other transaction. So it's having that awareness that legal is an input and also an output from TP analysis. It's not something that can be divorced from the TP process or from tax compliance strategies generally. So that was a very brief rundown of the fundamentals of intercompany transaction management and the role of legal. So let's dive in a little bit more detail and hopefully a bit more practically orientated. So the scenario is that you are either in-house within a particular group, or you're an advisor and you are supporting a particular group. And you are considering the potential need for action on intercompany agreements. So let's look at what the flags are going to be in terms of you needing to identify this as an issue. So on this slide, we've listed, I guess, the obvious signs that action may be required regarding a group's intercompany agreements. So just from the top, clearly, if there are new intercompany transactions which have been identified from a TP or tax perspective, then that indicates that there will be new agreements or at least modified agreements required. Similarly, new or updated TP policies, including changes in the markup percentages or changes in the structure of particular transactions. Clearly, if there's been a change in the group structure, so maybe there's been acquisitions or a group entity rationalization project, or maybe changes in the business model of the group, then that will indicate that the intercompany agreements need to be amended so as to reflect this new reality. Gaps in intercompany agreements, many groups are still playing catch up. And so in many cases, the internal tax or finance function will be aware that there are gaps in intercompany agreements. In other words, controlled transactions which are not documented in written, signed intercompany agreements. So obviously that's an indication that action is required. Similarly, for a group that does have certain agreements in place, but if you know or suspect that the agreements have not been updated for 2 years or more, or maybe have never been properly reviewed for alignment with transfer pricing positions, withholding tax positions, corporation tax deductibility positions, and so on, then that knowledge of neglect, if you like, is obviously a sign that at least some consideration should be given to rectifying the issue. Other scenarios that we come across in groups is those with large numbers of ICAs or long and complex ICAs. So we still come across groups which have hundreds, if not thousands, of intercompany agreements. A lot of them are historic. A lot of them have been prepared without reference to transfer pricing, functional analysis, or transfer pricing considerations. And so the sheer number of intercompany agreements indicates that there is likely to be a risk, because the more agreements there are and the more complex or the longer the agreements are, the less likely it is that anyone has actually properly reviewed them, and the more likely it is that there'll be some contradiction as between the agreements and the TP policies, as per, for example, the Coca-Cola cases, or many other examples could be given as well. Next set of warning signs would be if there's no clear matrix of transactions. So if a group cannot easily and quickly pull off an overview or a summary of each of the key transaction types within the group, between controlled entities, specifying the transaction type, the parties, so supplier, recipient, licensee, whatever it is, the contractual structure of remuneration, the pricing policy, and other relevant considerations. If a group does not have that to hand, then the chances are that it needs to take action on its agreements, because if there's no central reference point as regards the actual intercompany agreements and intercompany transactions that need to be documented, it's very difficult for a group to actually manage its agreements appropriately. And then finally, and maybe similarly, if a group has no central archive of intercompany agreements, so maybe it's been managing or so no central management of agreements, it's been done partly locally. Again, it's an indication of a risk in terms of defective or misaligned agreements or gaps in agreements, because that kind of fragmented management of intercompany agreements generally reflects a lack of control structure. And then the final point, if there are no documented processes for managing agreements, again, it suggests that there may be defects in terms of compliance generally. So the previous slide was about identifying potential issues. And obviously, in terms of potential issues to be addressed, just because you have identified a potential issue, it doesn't mean that it has the materiality such that it should take priority over other issues or potential actions. So the next step, once you have identified the potential the potential issue is to make a high-level assessment of the potential impact. In other words, why would the group care? What is the dollar sign attached to that? And is it material enough to actually warrant the group doing anything at all about these potential gaps and defects, or is it comfortable to do nothing? So that means really getting clear from a business case perspective on what are the issues. So looking at the left-hand side, typical consequences of gaps and defects. So number one is wasted TP costs. So if a group has been preparing master files, local files on a year-by-year basis, but has never actually been reviewing those master files and local files to see if they were actually aligned with their intercompany agreements, or maybe the agreements contradict the claimed TP policies, then quite possibly the group has been benchmarking the wrong transaction, or at the very least has been failing to take into account all of the economically relevant considerations for benchmarking, which means in effect it's not getting the benefit of the TP investment that it thought it had made. Moving on, obviously fines and penalties for non-compliance with formal TP requirements, or unsupportable positions as regards transfer pricing, withholding taxes, VAT, and so on, leading to unnecessary exposure to those types of risks. So it is important to look at that in the round and think not just about transfer pricing, because as I mentioned, for example, withholding tax issues can be as material, if not more material. And in fact, there is an interrelationship between TP non-compliance and withholding taxes, because TP considerations may be used by tax authorities to support a deemed interest payment which should have been made, or royalty payment. And so the amount at stake may be not just the TP adjustment, it may be fines and penalties in terms of historic withholding taxes or VAT issues and so. Moving on, unnecessary exposure to tax investigations and disputes. This relates to the whole investment in transfer pricing and tax compliance, which is undermined. Denial of corporation tax deductions. So this is really a key point, and we've had a number of recent cases on that point, including in Australia in February 2026, the ASN case, which was basically saying that an expired license fee agreement, which was in place intra-group but then expired, meant that there was no legally binding basis for the license fee payments which were paid, and therefore the corporation tax deduction was denied. So this is not unusual in terms of global positions and the kind of challenges which tax authorities are raising. Just moving down that list, so there are certain situations where there are enhanced personal liability risks for directors for breach of fiduciary obligations, which is entirely independent of tax and transfer pricing considerations. And that's potentially or particularly where entities have negative reserves, negative net assets, or solvency issues, those kind of things. And so in those situations, it is even more important for intercompany transactions to be documented appropriately, to be priced appropriately, so as to protect directors. And then we have the Amgen bullet point, which is risk of investor litigation for failure to manage and disclose potential tax and other risks due to failures in the compliance arrangements, which can include agreements as well. And then finally, adverse impact on proposed corporate transactions. In other words, especially for private equity backed businesses, or those which are planning to IPO or planning some significant corporate transaction. Transfer pricing and corporate governance due diligence has a far higher profile than it did 10 years ago, 15 years ago. And so being able to present a clear and clean position in terms of the legal documentation of intercompany transactions is going to help maximize exit values, and minimize bargaining chips. So all that is part of the thought process that in-house tax and finance teams need to assess, and they need to be supported by external tax and TP advisors so as to actually get clear on what is really the business case here, what legal action or input is needed, why is it needed, so identifying what is it that presents the highest risk and where possible, attempting to quantify that risk, and when is it needed? In other words, is this something that actually needs to be addressed now? For example, if a group has identified discrepancies between its agreements and historic TP or filing positions, then obviously the longer those gaps and defects remain unaddressed, the bigger the window of risk, or the larger the window of risk is for the group concerned. And there may be other specific deadlines and considerations, such as corporation tax filings, specific TP filings, and so on. So from a practical perspective, really the message is to focus on the business case and make the decision, is this actually something that can be safely deferred to a subsequent quarter or a subsequent year, or actually is this something that needs to be addressed now? And it's really the role of the in-house tax and finance function, but with proactive guidance from external advisors to make that judgment call and actually assess the business case. So moving on, and so assuming that you've made that assessment, you have identified that there are gaps, issues, defects in the agreements, and therefore weaknesses in TP positions, withholding tax, corporation tax, and so on, and you've made some quantification of the risk such that you have the business case, what is the most appropriate way to engage with the legal function? So that includes the in-house legal function and any other lawyers who may commonly work with that particular group. So I guess what we've got on this slide is stating the obvious, but number one, it is explaining the issue and the business case for taking action, because every function, including legal function in a group, will have their own business as usual list. They'll have their own to-do list. And so often you're competing for attention and resources. And it's the business case which is the key thing here. Number two is getting clear about the end result required and the deadlines involved. So the end result required depends on which financial periods need to be addressed, and what the nature of the gaps and defects are. So it may be that the first step is to look at the immediately prior financial year, and the end result required is to fix gaps and defects, to correct misalignment in intercompany agreements, and effectively rectify those agreements for that transaction or for the relevant set of transactions in that year, and to complete that by an appropriate deadline, for example, before finalizing the corporation tax returns and the TP documentation for that prior period. So it's about getting clear on what is the end result and what are the deadlines involved here. Third thing is to assess the existing legal capacity that is available. I would say pretty much all of the groups that we support over a given size have an in-house legal team. And naturally, the in-house team will be concerned to maximize the use of internal resources where they are available, and therefore to minimize the budget for external spend. And that means assessing existing legal capacity and skills and resources. And I have to say, we come across a whole range of different answers to those related questions. At one end of the scale, we come across large groups which have extremely sophisticated legal teams which are very clear about what it takes for agreements to be aligned with TP policies and with best practices. But other in-house teams will actually be focused on other areas such as M&A transactions or providing commercial support to the business, and may not regard this as being within their particular role. So it's important to have a clear understanding and a clear discussion about that. Next point is obviously building the team and identifying the stakeholders. So that includes obviously the in-house tax and finance function, very often the external TP advisors, but identifying the legal support and the wider stakeholders in terms of regulatory and finance, treasury, and so on. Step 5 is planning and implementing an appropriate approach. In other words, a project plan for the particular set of transactions that need to be fixed. And obviously keeping the legal team informed and updated. So even if the in-house legal team feels that this is not an appropriate use of their time, they will still need to be informed and consulted as part of the process, because the terms of intercompany agreements can impact the way in which IP rights, for example, are actually enforced within the group, especially for things like profit splits, obviously license agreements, CSAs, and so on. So it's important to maintain that dotted line relationship with the in-house legal team throughout the project. As part of this initial engagement, there are often questions about intercompany agreements. The in-house legal function or other members of the team may not be familiar with the interaction. They may not understand why legal agreements actually matter for the various stakeholders, and what the consequences of not having them in place are. Hopefully, you've already done the work in terms of the business case, but it may be that these FAQs are helpful for those kind of initial discussions, especially, I guess, the second two ones. So examples of groups which have actually suffered significant litigation claims or adverse impacts due to gaps and defects in their intercompany agreements. So those cases like Coca-Cola, Aspro, JP Morgan, ASN, and so on, those are ones that you need to be familiar with. And also the last question, can we just create agreements when a tax inspector asks for them? The short answer is that's probably not going to work, because the standard is clearly ex ante agreements. In other words, agreements signed in advance. Even if it were possible to backdate or memorialize an existing undocumented transaction, in practice, it's probably not going to be possible to finalize those memorialized transactions within the kind of timeframes that apply nowadays in an audit or inquiry situation. So from a practical perspective, that's actually not going to work either. So part of the conversation in terms of the in-house legal team and considering what is required is a matter of getting clear about what are the individual tasks which may or which typically need to be undertaken in conjunction with a project to create or create new agreements or rectify gaps and defects in intercompany agreements. So the color coding here is really black is the kind of legal support that I would guess any legal team in-house or in a corporate commercial law firm is going to be able to handle pretty comfortably. So legal due diligence, I'm sure pretty much every firm in that space will be able to do it. And similarly, the task of finalizing ICAs or creating signature-ready documents, briefing directors, arranging signatures, and arranging filings, in other words, IP filings and corporate filings and so on. The blue highlighting is really for those elements of the legal tasks which generally require a more specialist skill set, because it requires analyzing transfer pricing policies and transfer pricing documentation. It requires having an understanding of how transfer pricing works in the context of typical transaction types, like central support services or appointment of target margin distributors or profit splits or whatever. And that feeds into creating or confirming the matrix of intercompany transactions. It feeds into the gap analysis of existing agreements. and also reviewing existing agreements for alignment with TP policies. Because when you're doing that alignment review, you're really looking at 4 key areas of alignment. So first, it's the character of the transaction. Secondly, it's the treatment of risk and risk allocation. Thirdly, it's the treatment of intangibles in terms of prior ownership of intangibles, and also the ownership of intangibles created in the course of the arrangement. And then finally, the pricing structure in terms of alignment with the price setting policies. So those different skill sets really tie into the review aspects, but also preparing master intercompany agreements. So one thing that we commonly come across is groups which are using third-party agreements as the starting point for the drafting of intercompany agreements. And the reason why that typically leads to issues is that third-party agreements generally have a whole load of functionality which is not appropriate for related party transactions, particularly as regards the allocation of risk. And also, third-party agreements often contain certain procedural provisions or contractual processes which are not appropriate intergroup and which are actively dangerous, because if those processes are not actually followed in practice, then it undermines the credibility of the whole set of documentation. And also localizing intercompany agreements as needed. Generally speaking, when you're dealing with a group which has entities in 5, 20, 15, hundreds countries, it's not going to be realistic, and it would blow the budget to get local law input in relation to each of those countries. And so the question of localizing agreements is a matter of taking a risk-based perspective in terms of these local risks. And that those local risks relate to the structure of the transaction from a TP perspective, the pricing of the transaction, but also local regulatory and legal considerations. So generally speaking, it requires an understanding of international best practice in terms of intercompany agreements to perform that kind of task effectively. Common errors in terms of intercompany agreements or the handling of the legal aspects of intercompany transactions. We just put some examples of this on the slide here, but one of them is misinterpreting transfer pricing descriptions or just not pushing back on the tax or transfer pricing analysis. And there's so many examples of this in the case law. So that includes Singtel, the Australian case. It includes sketches in the US. It includes various other large corporates which have ended up implementing transactions which made no sense from a legal or commercial perspective. And it's difficult to explain how that arose other than the relevant legal teams not being properly involved or not understanding that part of their role is to really sanity check and, if necessary, push back on the structuring of transactions to make sure that it makes sense. Other things that we see is misalignment with, as between DEMPI analysis and the actual legal rights in IP. So what we are aiming here, or what we need to achieve here, is an alignment between form and substance. So it's not substance over form, because that presupposes that there's a conflict between the two. It's alignment between substance and form and actual conduct or operations and the actual data. Similarly, risk allocation, we see a huge number of distribution agreements, for example, where the risk allocation in the agreement is actually the opposite of what is purported to be the case in the TP documentation. And it's a totally unnecessary error to make, because it's something that is easily addressed if it is identified. I'm not going to go through all the points on this list. I'm just going to focus on the ones relating to pricing clauses, because in the past there was this idea, maybe 10 years ago, 15 years ago, that intercompany agreements should not reference the actual pricing. It should just say, the service fees will be an arm's length amount as determined or as agreed from time to time. Unfortunately, that approach just does not work anymore, partly for transfer pricing reasons, because it's a core concept in the TP guidelines, the OECD TP guidelines, that the transaction needs to be priced. It needs to be sort of delineated, priced, implemented, and then played out. And that only works if the pricing has actually been specified. But also there's this crossover with corporate tax deductibility and the requirement that the pricing be clear, unambiguous, legally ascertained or ascertainable. So what was previously considered as a time-saving approach, unfortunately, just does not work and does not give groups the protections that they need. And then the final one, fraudulent attempts at backdating. We still see this a lot. So groups trying to fudge the fact that they're putting in agreements now in relation to prior periods. There are situations where that can be done, and it's always better to address these issues sooner rather than later. But what definitely will not help and will not assist the group's relationship with tax authorities is trying to be clever and trying to give the impression or give a false impression as to when the agreements were actually signed. And many tax authorities, such as Mexico, are getting very specific as regards the evidence which is required as to the date of conclusion of a particular agreement. And so it's just not worth trying to trick anyone. So let's look ahead and so, well, where do you actually start? So you've got a group. You've identified the warning signals. There are gaps and defects. You've identified the business case in terms of not fixing the agreements. You've engaged with the legal function in terms of the resource that they have available and their level of capability or confidence in that. The question is, well, where do you actually start? The answer is there's no one size fits all answer. But typically, I would say when we start working with a new corporate group alongside its transfer pricing and tax advisors, very often, if we're starting the work in 2026, a natural starting point is to look at the prior year, 2025, to review the latest available TP documentation, and to go through the legal steps on the left-hand side box here. In other words, let's make sure we've correctly identified the legal operating model. Let's make sure we've correctly identified the transactions matrix, the stakeholders. Let's check whatever existing ICAs are in place for coverage and alignment. And let's go ahead and fix those gaps and defects in the agreements, taking into account the wider stakeholders. And as part of that exercise focused on the prior year, it may well be that the group will need to consider or reconsider its previous TP and tax filing positions in relation to those prior periods. And in terms of the timing for that kind of approach, really you want to be completing that work before the local entity accounts for 2025 and the corporation tax returns and the TP documents for that year are finalized. And that's because those issues that you've identified and hopefully fixed in the ICAs, intercompany agreements, are going to flow through into the TP analysis. And that means that having used the prior year as the reference point, you can then move on to the current year. So that would be 2026 in this case, which means that you're really just reviewing, well, what changes have there been to the transactions? Are there new transactions which are now taking place that weren't before? Does there need to be an updated legal operating model that needs to be documented? And basically updating the agreements to reflect the updated TP policies that are intended to be operationalized for this year, 2026. And in terms of the timing for that, what generally speaking, corporates should be advised to do is to complete that exercise before the end of this current financial year. In other words, you're transitioning to a proper process whereby agreements are put in place in advance. So it's catch up on prior year, gaps and defects, review changes in the current year, and then move ahead on a proper basis, which means reviewing in 2026 any planned changes in the structure or pricing of transactions which are intended to take effect from 1st of January 27 onwards, and to implement them accordingly. And then separately, from a process perspective, it's not just about fixing agreements on a year-by-year basis, but it's also about operationalizing the ongoing processes. In other words, this should include an annual refresh of whatever central description you have of the legal operating model, refreshing and creating processes for updating the central repository of ICAs, getting clear about roles and responsibilities as regards agreements, as well as other tax and TP functions, diarized review points, protocols for actually managing the updating of agreements and ensuring that the relevant book entries are aligned. So it may be that list sounds scary, but these systems, or the documentation of these systems, does not have to be long and complicated. It's a matter of expressing the basics in the briefest way possible, so that the group can actually live those protocols going forward. So, for example, what we're seeing for a lot of the larger, more sophisticated groups is that they have very clear protocols which provide that intercompany book entries cannot be made unless there is a signed and dated intercompany agreement in place, and the book entries, excuse me, are in accordance with the terms of those intercompany agreements. And just by way of context, what do we mean by legal operating model in terms of how it's reflected into the processes? It's really the legal equivalent to a transfer pricing master file. So it's describing from a legal perspective, how does the group work? What are the different entities? What are their roles? And that includes operations, assets, staff, finance, and including specifically which entities contract with the outside world, which entities hold IP and receive revenue, and so on. And the key point is that groups do change. They make acquisitions, they demerge, they make disposals, they rationalize their structure, and therefore this legal operating model should be regarded as really the blueprint on a financial year by financial year basis, and that should form part of the documentation which goes alongside and supports the TP documentation. So that's the overarching description, if you like, of the legal operating model. The next stage of granularity is for each financial year to confirm the matrix of intercompany transactions. And ideally, this should be expressed in a form which is used both from a legal perspective and from a TP and financial reporting perspective. And then that translates into the individual intercompany agreements as they are in force for the relevant financial year. So that's what we mean when we talk about a fit-for-purpose legal structure to describe a group's legal operating model. So I'm just going to pause here in case anyone has any questions, or there are any points that people wanted to raise before we go any further. Cool. Okay. Well, in that case, I'll leave these questions with you. If you do want to reach out after the event, please feel free to do that. And I'm just going to close by talking about what are the key takeaways and what resources and support is available. So the summary takeaways are: number one, be proactive. So this is naturally within the scope of responsibilities of tax, finance, and TP professionals. So you do need to take the lead. If you are looking at this from the perspective of a TP advisory firm or tax advisory firm, then this is a major opportunity to show that you are the trusted advisor and that you are taking a a proactive and client-centric approach. Number two is just the core points that legal considerations are an input into TP analysis. In other words, you can't do the TP economic analysis until you've understood the legal fact pattern, including the existing terms of intercompany agreements. But legal is also an output from TP analysis because a transfer pricing report or TP policy, which is not properly implemented, is going to have limited value. Number three is the point to start with the business case for action. So that means like what needs to be done, when does it need to be done, and why. And so unless those questions are clearly answered, it's going to be difficult to get the proper support. Next point is that you may well need to help educate the legal function and explain what is needed. And this is all part of the role. And it may well be that you have a very sophisticated legal team who is very well aware of how to manage intercompany agreements, whereas other teams may not see their role as extending to that particular task. Number five is the obvious: establish an action plan to fix gaps and defects. So that relates back to the where do I start question, and very often it's looking at the immediately prior financial year and starting from there. But there may be other considerations, such as you may have an imminent audit in a particular country, or you may have specific risks that you need to address urgently, in which case that might take priority. Number six is it's not just about fixing gaps in the agreements right now and defects in the agreements. It's also about establishing the proper ongoing processes going forward. And the final point is really the end result here that we want is audit readiness. In other words, when the tax or TP audit comes in 5, 6, 7 years' time, and maybe a lot of your colleagues are not around, or there have been significant changes in the staffing in the group, you need to have that centrally available defense file that includes not just formal TP documents, but also the agreements, the corporate approvals, the briefing notes to explain the commercial rationale for changes in the agreements or new structures. So in case you would like further information, we do have various free resources. So we have a regular newsletter, which is weekly for advisors and monthly for in-house people. So keeping you updated on developments that you should be aware of. We have a short briefing document called Intercompany Agreements in 60 Seconds, which may well be helpful in explaining to clients or to legal colleagues what exactly the issues are. We also provide training for TP advisors and in-house corporates, as well as in-house legal teams, on what they need to know in terms of intercompany agreements, including deep dives into specific transaction types such as profit splits and CSAs and so on. And of course, if you do have any questions or if you identify gaps and you need support, please feel free to reach out. You can either do that via our website, lcnlegal.com, or you can email us at info@lcnlegal.com. So I'm going to end this and just say thank you so much for joining. I really appreciate it. And I look forward to welcoming you on our next webinar. Thank you very much.